What if I told you that the US dollar, which still seems, outwardly strong on the global stage, is actually showing signs of collapse when measured against hard assets?
Hmm.
And what if the people buying up the world's physical gold and silver aren't the usual speculators we see on TV, but governments and major institutions?
Right.
That they're preparing for some kind of monumental shift in the whole monetary system.
That that is the crucial signal. It's the one thing missing from almost all mainstream financial discussions right now.
So that's what we're doing in this deep dive.
Exactly. Our mission here is to look at the collected evidence that suggests the world is strategically moving away from a financial system built purely on debt and institutional trust,
And back toward what?
and returning to assets that hold intrinsic physical value. We're examining why the price movements in gold and silver are not just random volatility, but, calculated long-term positioning signals.
And they're coming from the most informed players on the planet.
The most informed players, yes.
And the timeline here couldn't be more critical. I mean, the sources we've compiled suggest that what we are witnessing right now in late 2025 is a convergence of things.
A perfect storm, almost.
Yeah, institutional accumulation, major policy changes regarding metals, and flashing warning signs in the U.S. fiscal landscape.
And it's all happening at a scale we've just never recorded before. If you connect this to the bigger picture, this aggressive accumulation, it's all driven by a deep realization.
That the current system is unsustainable.
The current system of unlimited debt is ultimately unsustainable. The movement toward physical metal is the most honest, unfiltered reflection of that loss of faith by central banks and sovereign wealth funds.
Okay, let's start by looking at the charts, because the prices alone tell a fascinating story. Gold recently touched, the $4,050 to $4,100 range?
Right around there, yes. And silver's been showing remarkable strength near $49 to $50.
To an average investor, that might just look like a strong commodity cycle.
But what's truly fascinating here is the context. It's why this strength is so unusual.
Go on.
Metal prices are hitting these highs even as the U.S. dollar index remains relatively strong against other currencies.
And while the market keeps speculating on Fed rate cuts...
Exactly. Traditionally, that combination, a strong dollar and maybe stable rates, that should put downward pressure on precious metals.
But it's not.
The fact that they're surging suggests that something far more structural than cycle trading is driving this market. These price movements are a warning signal.
And that signal isn't about paper trading, which you said is key.
It's so important. The buying is overwhelmingly focused on hard physical assets, not just futures contracts or ETFs that, often rely on paper promises.
This is driven by the governments, the institutions, the people who really understand the rules of the game.
And the scale of physical delivery is just staggering. Since last November, the amount of physical gold and silver brought into the major trading exchanges has been unprecedented.
How much are we talking?
We're talking volumes in the neighborhood of 200 million ounces or equivalent units.
To clarify, when we talk about delivery, we're talking about two very specific, often opaque markets. Can you quickly define those for the listener?
Of course. We are talking about the COMEX, which is the primary commodities exchange in the U.S., and the LBMA, the London Bullion Market Association, which handles the world's largest wholesale trading and physical vaulting.
And when you say institutional players are demanding delivery...
We mean they aren't just buying paper claims. They are settling their trades by taking possession of the physical metal itself. They are systematically draining those registered vaults.
That distinction makes a massive difference. It's like the difference between holding a deed to a house versus physically occupying the house.
That's a perfect analogy. And this massive surge is driven by private settlement and institutional delivery, not by, the smaller, short-term retail speculation that might cause a temporary spike.
This action confirms their long-term strategic intent. So, if the buying is happening at that kind of scale, who exactly are these buyers? Who are the traders systematically draining the world's vaults?
The entities importing hundreds of billions of dollars of metal into the U.S. and globally are, they're universally identified as the most well-funded and strategically informed traders in the world.
And they're standing for physical delivery.
Actively. This behavior, showing you what they're doing with their capital rather than what they're saying in press releases, it provides the strongest possible confirmation that a strategic shift is underway.
Okay, here's where the policy side adds a really fascinating layer to this. It's one thing for traders to buy. It's another for governments to shift official classification.
Right.
The U.S. recently reclassified silver as a critical mineral, alongside others vital for tide and defense. This seems bureaucratic, but the implications are huge.
This is a signal that metals are moving beyond being mere investments. They're moving into the realm of national security.
So silver, essential for solar panels, microchips, defense tech.
It reflects a changing mindset. Metals are now viewed as strategic war assets tied directly to manufacturing capacity, defense readiness, and energy independence.
Why does that designation matter in a practical sense? If silver is now a critical mineral, what changes for a U.S. manufacturer?
It immediately opens doors for prioritizing supply chains. It means governments can invoke policies like priority permitting for mining projects, offer targeted subsidies, or even implement export restrictions to ensure domestic availability.
So it shifts the focus from price discovery to resource control.
Precisely.
Yeah.
The resource control.
And this leads us directly into the global race for that control. We've seen this massive shift in transparency about official holdings, which seems directly related.
Absolutely. One of the clearest warning signs comes from the World Gold Council. 4 years ago, governments reported about 90% of their official gold buying.
And today?
Today, they're reporting only about 1/3. They're deliberately being opaque, keeping their accumulation strategies secret from international scrutiny.
And of course, we have to talk about China's strategic position in this global race.
China is central, not only as the world's largest producer and consumer of gold, but also a dominant player in silver.
And it's widely assumed they own far more than they officially report.
Oh, perhaps 10 times their stated holdings. And on top of that, they're actively tightening silver exports.
Which confirms they're committed to keeping physical metal inside the country.
Yes, and other critical elements too.
The sources highlight that the bottleneck isn't just digging metal out of the ground, it's the refining capacity that's the real choke point.
That's correct. And China controls the refining for over 90% of the world's rare earth minerals. And they're extending this to other precious metals.
How are they doing that?
They're using infrastructure projects from the Belt and Road Initiative, deepwater ports, rails to secure raw materials all over the globe. They're going into countries like Peru and Mexico to acquire ore. It's the partially refined concentrate of gold or silver. They ship it home for final processing. This isn't just a commodity trade. It's a comprehensive long-term strategy for resource control.
Let's pivot now to the elephant in the room. The debt. The debt that's driving all this strategic demand. U.S. debt is at an astounding $38 trillion, not even counting unfunded liabilities. And the recent rate of accumulation is shocking. $500 billion added in just the last 6 weeks.
The correlation is undeniable. You just can't ignore it. Record U.S. debt is driving record gold demand because foreign governments are simply losing faith.
Losing faith in the long-term value of the dollar.
Exactly. As a reliable store of wealth, they're diversifying rapidly into gold because they see no sign that Washington is taking fiscal discipline seriously.
But if foreign governments are dumping dollars, why isn't the dollar index, the DXY, showing a total panic? The DXY is still pretty high, only down maybe 8 or 9% against the euro.
And that's where the misleading metric comes in. The dollar index primarily measures the dollar against a handful of trading partners, many of whom are facing their own severe fiscal headwinds.
I see.
When you measure the dollar against real value, the picture shifts dramatically. Against silver, the dollar is down 70%.
70.
And against gold, it's down 65%.
So the strategic movement isn't about devaluing the dollar against the euro. It's about devaluing it against real commodities.
Tangible assets. And you could argue that the ultimate strategic goal of this debasement goes beyond just making that $38 trillion debt easier to pay off.
What's the bigger goal then?
While debt payment is a motivator, the larger, more profound strategic goal is to enable the U.S. to restart its domestic manufacturing base. The U.S. cannot be reliant on potential geopolitical adversaries for critical supplies.
Right, from pharmaceuticals to military components.
Precisely. The sources suggest that by debasing the dollar, making commodities more expensive, the U.S. makes its own manufactured goods globally competitive again. It's a painful but necessary step.
Which brings us to the ultimate confirmation point, the insider allocation shockers.
Yeah.
We are seeing major institutional strategists openly recommending gold allocations that completely abandon the old 60-40 model.
That's the one. The 60-40 stock bond model has dominated finance for decades. This signals that the insiders believe the monetary shift is, well, it's imminent.
This is the critical evidence that the shift is real and happening now.
The individuals who manage trillions of dollars are not changing their fundamental investment philosophy unless they have overwhelming data confirming they have to.
Let's look at the specific examples from our sources because they're pretty significant.
Okay, take the chief investment officer of Morgan Stanley. He recommended selling half of bond holdings and allocating 20% of assets into gold.
So the standard 60-40 model becomes 60-20-20 stock, bond, gold.
That is a truly revolutionary recommendation coming from a major Wall Street house.
And Michael Hartnett at Bank of America, whose newsletters guide the biggest institutional traders.
He advocates an even split. 25% stock, 25 bond, 25 short-term treasury, and 25% gold.
25% gold? Wow.
And if that isn't enough, consider Jeffrey Gundlach, one of the most respected figures in the bond market, stating openly that a 25% allocation in gold is not overweight.
It's not overweight. 25% used to be considered a radical fringe position.
And now, it's mainstream advice for institutional managers.
What's crucial is who these analysts are talking to.
Yes. They're speaking directly to the asset managers who are importing those billions of dollars of physical metal. This confirms that those at the top are systematically preparing, while the general public remains highly leveraged in equities, ignoring the serious warning signs.
It's preparation, not a trade.
It is. Gold and silver are becoming the essential measuring sticks of value as confidence in the fiat currency system erodes. The steady, consistent strength we see now is typical of the early stages of a monetary transformation.
A phase where the informed accumulate quietly.
Before the general population realizes they need to join the chase.
Now let's look at the quiet warning signs deep within the financial plumbing itself, connecting this insider accumulation to systemic distress.
Right.
The sources point to a panic the Federal Reserve had to deal with recently, largely without significant mainstream coverage.
This involves the repo market. To simplify, the repo market is the short-term lending market where banks lend to each other, often overnight, using high-quality assets like treasuries as collateral.
It's the essential lubrication that keeps the financial system liquid.
It should run silently in the background. Normally.
But recently it didn't. The sources reveal the Fed injected $125 billion into the repo market over a 5-day stretch.
$125 billion, citing an effort to ease funding stress.
Wait, that amount of emergency intervention, that sounds like crisis-level stuff.
It is highly concerning. We saw comparable crisis-like behavior during the 2008 Lehman collapse and the 2019 repo market blowout. While the Fed framed it as a technical issue, the scale suggests something fundamental isn't flowing correctly beneath the surface.
And this situation is compounded by a structural concern about the Fed's independence.
Yes, when you see key positions being filled by politically connected advisors, it raises questions about how much objective monetary policy can truly exist.
The sources highlight the appointment of figures like Steven Mnuchin, who was the architect of the Plaza Accord.
And when politically selected individuals occupy positions meant for neutral monetary experts, it implies that the resistance against political agendas is dissolving. This leads directly to the ultimate loss of confidence.
And that loss of confidence has a price tag attached, doesn't it?
It does. Goldman Sachs, addressing their clients, put a firm number on this fear. They stated that if the market fears the Fed has truly lost its independence,
then what happens?
Gold will quickly breach the $5,000 mark. That forecast is a symptom of the erosion of institutional trust, confirming that the strategic positioning we see is preemptive against this very crisis scenario.
So let's bring this all back to the key takeaways for you, the listener. This deep dive shows that the strategic shift from a system built on debt to one driven by physical value is, well, it's undeniable.
And it's fueled by three massive intersecting forces.
First, national security needs.
Demonstrated by the classification of silver as a critical mineral, confirming the need to control physical resources. Second, catastrophic fiscal irresponsibility, with $38 trillion in U.S. debt, driving unprecedented dollar diversification by foreign powers.
And third, the overwhelming institutional confirmation. We're seeing major strategists advising institutional traders to move 20 to 25% of their portfolios into gold.
A level unheard of just a few years ago.
The global race for physical metal is tied directly to the need for countries to secure their manufacturing future and reduce reliance on others.
The insiders know what is happening, and they are moving quietly while the majority remains focused on short-term market noise.
Which leads us to the final question.
Do you believe gold and silver are simply rising due to normal inflation cycles? Or are they being strategically positioned by the world's most informed players to anchor the next phase of the global monetary system? That is the question you should consider when viewing your own financial planning and understanding of currency value today.